by training, I've got over 25 years in mining, both in industry and in capital markets, including having built and operated my own operations. Why we like black iron? We think it's the best undeveloped iron ore project in the market. You know, Wood Mackenzie says it gives the highest return of any unfinanced greenfield project in the world. You know, at 68% iron, it's a very high grade product, which puts it in the top 4% in terms of quality globally, which means the very high premium product. If you look at the long-term consensus iron ore price of about $69 per ton, black iron will receive around about $100 per ton for that. But it also substantially reduces the greenhouse gas emissions when you use this high quality premium product in steel production. This also has a knock-on effect in terms of OPEX at $33 per ton. According to Crew, it's the lowest cost undeveloped pellet feed project globally. It's located in an existing producing district. You've got ArcelorMittal, Metinvest, Everard Steel, and Ferrexpo all in the district. I mean, you've also got existing infrastructure and logistics. We've got power, rail, and port LOIs in place already. And probably most importantly, the company's got a very highly experienced management team, which is more than capable of delivering this project. In terms of our valuation, if you look at where the iron ore prices are at the moment, about $168 per ton. If we use a consensus long-term price of about $68 per ton, accepting that you've got premium products, we will receive about $100 per ton. NPV, 8% discount rate post-tax. We have a valuation of about 1.8 billion and a 39% IRR. If you look in terms of peer comps, earnings multiples, we get a valuation between 2.5 billion to 3.16 billion US. Given the sort of state, if we do a very, very hefty discount to risk that, we get a valuation of currently 1.8 to 3.16 times the company's current market capitalization, which is why I think, you know, all things considered, this is the best undeveloped iron ore project in the world in the market currently.
Mark, that's great. Thank you very much. Just on that note, so as of the opening bell, I think you're roughly in Toronto. The company's currently trading at about 46.5 cents with a Canadian market cap of just over $122 million. And we think on a 90% discount rate, it should be roughly worth about $360 to $400 million today. One of the things actually I wanted to mention at the beginning is we were really looking for companies that we thought had assets that would become operating mines within the next couple of years. As much as I love exploration stories, you know, I really wanted to find a project and a management team and a company that could take something through and benefit from this current resurgent commodity prices. And we very much believe that black iron has all of those. But with that, let me pass to Matt. Matt, can I ask you just to do the briefest of your backgrounds, and then we'll just run through the highlights, and then we can then get back to people and do more in-depth one at a later date.
Hi everyone, so I'm Matt Simpson. I'm the CEO and founder of Black Iron. My background is I'm a chemical engineer with an MBA. I started my career with a company called Hatch, which is a global engineering consulting firm. I used to design metallurgical refineries. I then constructed them before joining Rio Tinto, where I worked in their iron ore division for about 10 years' time. My last role was the general manager of the mine at the Iron Ore Company of Canada, where I had about 650 people that report to me, managed about 300 million US a year in spend. So I've built mines, I've operated large mines, always wanted to do something more entrepreneurial, and founded Black Iron. So how about I'll walk everyone through just really quickly some of the highlights on Black Iron's story. So as mentioned earlier, Black Iron is ranked by two highly regarded market intelligence firms, being Wood Mackenzie and CRU, as having, in Wood Mackenzie's case, in the bubble chart on the left, the highest after-tax internal rate of return of any development stage iron ore project in the world, and one of the highest iron contents. In the bar chart on the right, done by CRU, you can see that this is not just first quartile operating cost, but it's the lowest cost undeveloped iron ore project in the world. The reason why is that iron ore is a bulk commodity. So it's all about moving large volumes of material at low cost to your steel mill end customer. And to do that, proximity to major infrastructure, including railways, power lines, and ports, is what makes or breaks the economics of your project. In our case, the project is located only 2 kilometers away from the government-owned railway, where we've secured more than 20 million tons capacity, out of which we need 8. There's high voltage power lines that run right beside that rail, with the substation that we'll connect into only 30 kilometers away, also with capacity. And we can hit 5 different ports in the Black Sea, ranging between 230 and 430 kilometers, with our preferred port being able to take the large Cape-size ocean-going vessels. There's also a city of 750,000 people, only 8 kilometers away, that supports the 7 operating iron ore mines within 40 kilometers of us. And in that city, you have highly skilled labor that currently makes around $10,000 a year for an electrician, mechanic, welder. To put that in perspective, in Canada, when I ran Rio Tinto's operations, I was paying around $120,000 for a skilled worker, and that was about 30% of our operating cost. In Australia, you pay upwards of $180,000. So in Ukraine, of course, there's going to be appreciation in the price of labor, but right now it's about 1/10 to 1/20th of what it is in some of the other areas where a lot of iron ore mining is produced. So we're not constructing any major infrastructure, and what we are constructing and operating with is that local, highly skilled labor. For investors that are also very conscious of the environment, social, and governance, I think they're going to be very pleased with this investment because we're going to be producing a 68% magnetite pellet feed. So when people talk about the price of iron ore being $165 today, they're talking about iron ore that is 62% iron and in a fine material that is typically sintered. In our case, because we're at 68 or 6% higher than the benchmark, we not only command a premium price, but we also cut about 30% of the emissions that are generated in producing a ton of steel. So it's a much more environmentally friendly way to make a product that's required for so many applications in our everyday life. When we talk about the grades of iron ore that are produced globally, the reason why 62% is the benchmark price is that majority of the iron ore produced in the world today ranges between 58 and 65%. At 68%, which is what Black Iron is targeting to produce, we will be in the top 4%. So this is an ultra premium product with a premium price, but more importantly, again, much more environmentally friendly way to produce steel. In terms of our project economics, this is going to be a phased build. Because we're so close to all that major infrastructure, we don't need to start with a massive upfront project like you'd normally see in the iron ore sector. You'll typically see projects starting at least 8, usually even 10 million tons a year, billion-dollar plus type price tags, simply because every kilometer of rail that you need to construct is about $3,000. Every kilometer of power is about 1,000. So if you're even just say 200 kilometers away from your port, you're going to spend $500 million on infrastructure before you even touch building a mine. In our case, we're able to start production of 4 million tons a year of that high-grade 68% product for $452 million. Our cost to mine, process, rail, and load an ocean-going vessel is estimated at $33 a ton, and that benchmarks off very well on the 2 producing iron ore mines that are literally 1 kilometer away from us. We used a very conservative long-term iron ore price of $62 a ton, then made adjustments for our iron content, low trace elements, and shipping costs to China to come up with a realized iron ore price of $97. When you put that into a cash flow model using a 10% discount rate, it provides a net present value of 1.4 billion US, 34% after-tax internal rate of return, and it's going to generate about 300 million a year of after-tax free cash for its 17-year mine life. That's very important because it not only allows us to quickly service our debt, but also allows us to potentially pay a dividend to shareholders and self-fund an expansion from 4 to 8 million tons, which will cost an incremental $364 million. So some people might be wondering, how does a company with a market cap of 100 million US ever expect to fund 450 million? And even looking at that 450 million, you still need to include things like working capital, value-added tax timing delays, financing costs. So that real number that we need to raise is probably closer to about 500 million on a fully grossed up basis. I think the first thing that's important to do is to split the project between equity and debt financing. And we're using a fairly traditional 40-60 split. So we look at that 40% equity, it means we need about 200 million of equity and 300 million of debt. We've already secured a royalty from a US-based group for $100 million. So roughly half the equity is already taken care of by that royalty. And what's beautiful about a royalty is that the royalty providers only care about what your future cash flows are and not about what your current market cap is. So that allows us to raise a very large portion of money without incurring dilution. We've also received expressions of interest from 3 different construction companies, out of which we'll select one that is looking to invest $65 million. And the final piece of the puzzle is that we have pretty much every major global trading house and several steel mills that are all competing to secure the rights to purchase our initial 4 million tons a year product, likely for life of mine, at a slight discount to the market price in exchange for making an investment towards project construction. On the debt side, we already have expressions of interest ranging from 260 to 300 million from some major European banks. And we've also started to receive expressions of interest from some export credit agencies and for political risk insurance, which will allow us to push that debt closer to the upper end of the 300 million, and possibly even slightly higher. What's really exciting about the company at this period of time is that while 2020 was all about pulling those expressions of interest together, 2021 is all about moving them to binding commitments. The very first thing that's going to happen, and it's literally weeks away, is securing that offtake agreement with a major steel mill and trading house. After that, we're going to look to go binding on our construction contract. We're also updating our feasibility study, completing an environmental impact assessment to the Equator Principles of the World Bank Standard. There is some land that we need transferred from Ukraine's government that we've signed a memorandum of understanding on. We also have the support directly from President Zelensky on his official website for this project, and we expect that land to be in a binding contract sometime this summer. In parallel to all of this work, we're going to have the royalty provider, the senior debt, and the political risk insurance people doing their independent due diligence to move those expressions to binding contracts by the fall. And if all goes to plan, we should be starting construction very early next year, which will take around 2 years to complete. So very, very exciting year for Black Iron. Every time we hit one of these major milestones, we're going to make a big announcement, and that should be a catalyst for the share price. We are main board Toronto Stock Exchange listed with secondary listings in Frankfurt and on the US OTC. There's 260 million shares out basic, 342 on a fully diluted basis. There's many different ways to evaluate iron ore companies against each other. One of the ones that we're looking at is enterprise value divided by contained reserves in the ground. That places Black Iron at around 44 cents. And probably the best peer benchmark to us is London Stock Exchange listed Fair Expo, because they are a producing iron ore mine in Ukraine, and they're currently valued at $5.44. Another good peer benchmark for our potential is Champion Iron in Canada, which trades on the Toronto Stock Exchange and is valued at around $8.80. So as you can see, there is tremendous potential upside for our share price as we move the project through the development stage and into operation. We're located in the center of Ukraine in an area called Dnipropetrovsk, and it's the city of Kryvyi. There, again, is 7 producing iron ore mines within 40 kilometers of us, and we're literally right next door to ArcelorMittal's producing iron ore mine, where they're currently investing $1.8 billion to modernize and upgrade that facility, and to Yuzhny, which is jointly owned by Metinvest and Evraz Steel. From there, we take the railroad straight south down to Port Yuzhny, which is very close to the city of Odessa, where again we can take the large Cape-size ocean-going vessels. We'll load those boats, and we can transport our product to steel mills in the Middle East, which are in very close proximity to us and require that very high iron content. But we can also easily hit the growth markets of India and China with this product. So in summary, why should people look at Black Iron? Why now? Well, iron ore has been the top price appreciating commodity over the past year, reaching a 9-year high. And this is the top ranked undeveloped iron ore project in the world, on the brink of having all of our financing for construction secured. So with that, Daniel, I'll pass it back to you.
Always a problem of trying to be efficient and mute yourself off there. Matt, thank you very much indeed. I said this was just designed to be a very, very brief highlights. I will be making calls to almost I hope everybody who's receiving this email today, which I think actually will be going out, although it's Friday, it'll be going out early on Monday morning once we've edited up and changed around. So for those parties that would like to have a more in-depth discussion with Matt, please do get in touch. If anybody would like to have a more in-depth discussion with Mark or to go through the model, we'd be delighted with doing that. We've done 3 previous IPOs in Ukraine. Actually, I was last in Kiev about 18 months ago. Despite there, I think it is one of the most beautiful countries in Europe. Odessa is actually a fantastic place. We're doing down the port down there. And we very much look forward to when it opens up, getting a site visit down in due course. But Matt, thank you very much for your time as always. Mark in London, have a fabulous weekend. And to Mark in London, to other Mark, thank you always for your input. Gentlemen, talk to you soon. Thanks.